Hey guys, I just wanted to kind of record the overall sentiment that the market has currently in S&P and also in Nasdaq. I'm talking about the U.S. market. I'll talk again more about the Canadian market, in different video. But this time, I just wanted to just talk about what I'm seeing in the U.S. market, and just wanted to give you my update, give you my point of view, what I see, how things are rolling off. So currently, right now, there's a lot of volatility. If you look at the VIX index, for both for the Nasdaq and for the S&P 500, you have a huge uptick. Okay, market is definitely nervous. Okay, and then you see that in the crypto market as well. So crypto market has declined a lot, in starting of this month. So what is happening? I think if you listen to Cathy Wood, she's talking about the overall liquidity kind of drying up because of Treasury and the Fed, not providing liquidity, and there's a sentiment that is changing up, that there's going to be a tightening, quantitative tightening, that might be possible instead of being more dovish. I think there's a lot of people who are going into the opposite direction. So I think those are some of the things that are actually creating a lot of nervousness in the market currently, and you see the volatility going up, and it's impacting the equity and the crypto market. Again, inflation-wise, if you listen to Cathy Wood, I think she's definitely in the camp of overall deflationary environment coming up in the future, just because of the fact that the tech sector itself is getting hammered by a new technology and with the advancement in AI. So this is overall deflationary cycle. That is a long haul deflationary cycle that is basically going to be coming up in the tech sector, and that's going to impact all the other sectors. And that's what she's talking about. And the fact that labor market is going to get worse because of that, it's also a major factor in terms of, again, being market being nervous. We don't know what's the overall impact of these type of technologies that are actually definitely going to disrupt a lot of the labor force. So let's listen to what Cathy is saying. She's actually kind of, I think, overall bullish in the market, but she talks a little bit about the monetary and the fiscal policy. So let's listen to her, what she's going to say about that.
Everyone back, so to work over the weekend on a continuing resolution. So it could be a little sooner than November 17th, but then the funds will be flowing again. So again, this is short term. I don't like what we're hearing from the Fed, because I do think that they are missing some deflationary signals out there. And we'll get into a few of those. So let's go through the charts, and we'll start, as always, with the budget deficit, since that has been top of mind.
By the way, this is Cathy Wood talking in her monthly podcast channel, YouTube channel. She talks about the overall market sentiment and what she thinks about as we go into the month. So this is just a clip from there.
A record-breaking deficit during COVID. It is coming back. You can see we're at 5.7%. Which is better. We were not too long ago, almost 8%, so getting better. And I do think there are a couple of things going on. The government shutdown has been accompanied by a reduction in force recently. So again, I think Doge is having an effect, and an ongoing effect. And then on top of that, we have a more broad-based reduction in force. We know one of the pressure points, we've heard that Secretary Duffy has said that we're going to be canceling 10% of all flights. That's a little bit more pressure on the government to get this thing going. And then I'm going to show you a chart on SNAP. That's the Supplemental Nutritional Assistance Program. We'll get to that in a moment, to give you a sense of really how out of control spending was, and in some senses still is. And yet this is a political football, as always. This used to be called food stamps, I think. Before going there, I do want to reinforce that we think after this short-term period of discomfort, and it is uncomfortable, believe me, I know, that the rolling recession we've seen in the last few years will turn into a rolling recovery, and we're getting some green shoots already. Employment lag, so the unemployment rate probably will continue moving up, even as this rolling recovery gets underway. And then we think next year, we will be in much more of a productivity-driven almost boom in economic activity, mostly because of this chart. And I know I've presented it, but for those of you who haven't seen it, I wanted to make sure everybody has seen this, everyone interested in the know. And this came out of the tax package in the One Big Beautiful Bill, OB3, July 4th. And what you see here, manufacturing structures, this has never happened before, full depreciation, 100% in the first year of service. Normally, depreciation takes place over 30 to 40 years. This is turbocharging the concept of accelerated depreciation. And companies putting manufacturing structures in service within the next 3+ years, they just have to be started by the end of 28, will be able to depreciate fully in year one, which means they're probably going to get a big tax refund. And then you've got equipment, domestic R&D, and software. So I would say that's very innovation oriented. Those will be depreciated in their first year of service completely. And that change has been made permanent. So it's been legislated. That has never happened before. So these are very pro-growth, pro-business policies. And we think they're going to attract a lot of foreign direct investment into the United States. Effectively, you can see the corporate tax rate. So the effective corporate tax rate.
Okay, I'm not going to go into the details of the corporate tax rate, but again, I think what she's talking about is the fact that most of the policies that are coming out from White House and from all the tax changes that's going on, that's definitely going to help corporations in terms of, again, getting more profitability, and that's going to drive the overall demand in the market. So that's what she's basically indicating that fact. And I wanted to switch gears and talk about a little bit about the other side, because this is not hunky dory every time, right? In terms of looking at the market and seeing that everything is positive. The biggest thing that I see is the overall consumer sentiment, from the University of Michigan's Consumer Sentiment Index. So if I can show you the chart, like how it looks, it is kind of miserable. Like the overall decline in terms of the way that we see, from the past, like probably from past 3 or 4 years, it has during the COVID time, it was declining. It declined really very quick. Like you can see from 2020 June, that was a huge drop, and then after that it spiked up and then went down to the overall, downward trend towards May of 2022, and then it just jumped up, and then now it has gone down again. So this is where I feel like there's a huge swath of people, especially in the retail side, and I'm not 100% sure on the institutional side, but definitely there is no positive overall sentiment, from the consumer side, and that's actually hurting their overall spend. I think especially from the discretionary spend, they are not spending as much as they should. That's actually bringing the GDP percentage down overall, and I think that's creating a huge impact overall in terms of the overall sentiment the market is seeing and kind of the nervousness that we are seeing. So this particular index is not at all helping overall. If you look at it, from a consumer standpoint. So what's going to happen? So I think the next thing that I wanted to talk about is again from Cathy Wood. She's going to talk a little bit about the housing and the consumer sentiment. And I think I want to just emphasize on the fact that what she thinks in terms of how the housing consumer and the credit cycle is behaving at this moment.
Rates will have to come down a lot. Here are prices. Okay, so new home prices have been falling for a while, but not enough, clearly, because they're not clearing the inventory from that builders have. You can see existing home in the green line, existing home prices, those increases are continuing to slow. They're moving towards zero as well. So let's see what happens in the next few months there. Loan delinquency is another measure of consumer pain out there, which again, I'm sure is one of the reasons velocity is rolling over, but the saving rate is not going up. Delinquency rate, so subprimes in purple, all is in green. We're really reaching levels seen in 0809 for both. And I think one of the reasons is we now have Uber and Lyft. Maybe people who are experiencing or suffering in the current economic environment are just saying, I'll let them take my car. I don't care. I can pay as I go with Uber and Lyft, and soon autonomous. Here, flipping into capital spending is non-defense capital goods, new orders for them. And we think this has just begun. We think we're at the beginning of a big cycle here in the United States, thanks to tax policies, foreign direct investment, and so forth. So we think, if you look at this, it used to peak out at the same level over over the last 25, 30 years. And we've burst through that. We had a little bit of a test, and now we're out the other side. And of course, AI and power are driving this, but we think it's going to spread. Here you can see the trade deficit. It's building again, and this is something we predicted. If our economy, which in real terms is growing faster than other economies, if that is true, and actually if we accelerate relative to other countries the way we think we would, the deficit could continue to increase as we import more and export less purely because of the differential. Dollar is not crashing. It has been on the weak side recently, but it's not crashing, which is the
Yeah, so one of the things I wanted to also talk about the factor is the strength of the dollar. It has been really, really difficult to see this kind of a trend, which is amazing, like how dollar is basically been holding up overall from from any other currency. Like you talk about you talk about like talk about DXY. DXY is kind of close to 100. There was definitely a time when a lot of the people were thinking that dollar is going to go down, but that hasn't gone down. So you can see that it has tested a lot of times this resistance level, or sorry, this support level. It went down, but now it is coming up again. So we don't know whether this trend is going to continue towards the upper side. My expectation, and I think our hope is that this particular support level has become a resistance now, and there might be a chance that it might go down down towards the bottom side. But let's see what happens. But this is another thing that she's emphasizing on the fact that the dollar index or the dollar in terms of the other currencies has been strong, very strong so far. So let's see what she says about the the other
narrative out
indicators.
there. Here you can see the S&P again. This is earnings per share. So you saw straight up earnings per share are up, and we do think the ChatGPT moment 22 was a very important moment. You can see earnings were starting to tip, and then all of a sudden they turned right back around. Here's the commodity index. So are we in an inflationary world? The commodity index would say no. You can see we peaked in 08, and that was because of the 3 easing rounds in the late 90s, early 2000s. We're well down from that, and we are where we were in the early 80s, early 90s, and so forth. Here you can see some of the indicators we've been showing you for years now. Metals to gold ratio still falling. What is going on? I think it's China, and we saw that exports to China, exports to the United States from China were down 25%, I think, in September. They were up 3% to the rest of the world. What does that mean? They're probably cutting prices more aggressively in order to get increased uptake in the rest of the world, given what's happening in the US. That's a deflationary impulse, all right. And you can see the green line here is Treasury yields. Why aren't they as highly correlated today as they have been? The high correlation stopped in 22 when the Fed started tightening. Well, maybe if the Fed eases, this will come down more rapidly. And we think it will. And we think the inversion of the yield curve might continue for that reason. Copper, so the idea of, okay, metals to gold, that has broken down completely. Is it only because of gold? Look, copper is increasing in price, just not as much as gold. That could be, but there is another reason. Copper is behaving differently from many other metals. In anything electric vehicles and so forth, data centers, lots of copper. So this could be a relative price shift for copper. And
so one of the other things I want to talk about in terms of the commodity market is that yes, there is definitely the upward trend, especially with copper and with gold, even with silver. But if you see the overall commodity market in terms of the other types of commodity that are not directly associated with the with the metal or with any of these materials that are required from chip making or for manufacturing purposes, they have been down. Okay, they have not gone up. They have actually pretty much stayed at the very low levels. So it's only like few types of commodities that we see that there has been such a big appreciation in past probably like 7-8 months. So it's not all over the commodity market. The overall commodity market hasn't been performing that well, as you can see from the Goldman Sachs commodity index that she showed before.
and not the economic indicator that it has been historically, and would suggest that that's broken down because manufacturing has been negative, contracting in the US for 3 years now. Here, for market-based indicators, S&P to gold, this one we've been watching like a hawk, gold up, S&P wobbly. So you see testing. We do think it's going to resolve to the upside ultimately, especially if the chart I showed you earlier with gold price going down relative to money supply, if that is what happens now. The odds are high that it will happen because as we saw from that chart, there are only 2 other times it's been this high. So we do not think it's going to resolve like the 70s when S&P fell relative to gold dramatically because inflation was such a problem. We think quite the opposite, deflation is. And here's an example of that. Price of the S&P relative to oil. The oil price is going down. That's a massive tax cut. That's good. And we think this will be a leading indicator of the S&P to gold. Here is the treasury yield over, well, we saw the golden age. We had 40 years of declining long-term rates on balance, and that has changed. We didn't want them to continue going down. The quantitative easing and 0% interest rates basically suggested that the market was not working. We want the markets to work. We don't want the Fed to manipulate markets. And so the Fed is not manipulating anymore in terms of, certainly not in terms of easing. It may be too tight, and that might be what this chart is saying. We shall see. Here are spreads, not a care in the world. This is high yield spreads, so high yield rates relative to 10-year treasuries, and not a care in the world. And, I find that very interesting. And I think it's partly because where are the excesses in the markets? They're not on the equity side of the equation. They are on private credit side and maybe private equity side, but certainly private credit, that search for yield. I think that we're seeing that here. And we've seen First Brands and a number of blowups out there, still not affecting this. Maybe it did for a moment in time. But we think that there has been a lot of ill-advised lending out there in the search for yield, and that this will move up as more of these, I'll say, blow-ups occur. And then
Okay, so I think, so Bitcoin to gold ratio, again, that's just indication of how well the, Bitcoin is doing, even though, gold has been up for so long. But I want to switch gears because I don't want to talk about what kind of indications are we seeing overall from a market standpoint. It's you can't just have only one side of the coin, because obviously you want to see the other side as well, and you want to see the talk. You want to listen to other people who have been there in the market for so long, and you want to see what kind of overall market that these guys are seeing from a different perspective, because you can't look at just equity and crypto and then talk about the fact that these are the leading indicators and they're going to be showing you the exact expectation in terms of how the economy is going to behave. But if you look at the overall bond market and see how they are performing, I think that's going to give you another side of the coin, and see how people are interpreting some of the things that are going on in the bond market. So Jeffery Gundlach, I think you guys probably know him. He's been there for a long time. I think he's got like 40 plus years of experience, and he's actually came to Bloomberg podcast and talked about some of the warning signs that he see, and obviously he thinks that the market is overvalued at this moment. And you want to understand the perspective from his side, like what he thinks. So listen to him, what he wants to. What he has to say at this moment in terms of the overall financial assets being overvalued.
Of the Treasury issuance of the last 12 months. And what's interesting about that is the Fed has been cutting interest rates over the last 13 months. And historically, when the Fed cuts interest rates, of course, short-term interest rates decline, definitionally at the Fed funds level, but also 2-year Treasury rates decline, 5-year Treasury rates decline. In fact, long-term Treasury rates have always declined subsequent to the first cut by the Federal Reserve, and particularly when you're in a sequence of Federal Reserve cuts, and that's certainly been the case with now 150 basis points. But this time, all interest rates outside of the 2-year are higher than they were before the Fed's first rate cut. That just never happens historically. Another interesting thing that has never happened historically is earlier this year, during the tariff tantrum of late March and early April, stock market had a pretty significant correction. And it was going back to around 2000, it was the 13th correction in the S&P 500, defined by a drop of 10%, at least 10%. In the 12 corrections before the one here in 2025, the dollar went up when the stock market went down as a flight to quality asset. That didn't happen this time. When we went into that correction earlier this year, the dollar went down. It usually goes up by around 8%. And in the first quarter, early second quarter of this year, it went down by around 10%. So what is happening here seems to be that the pattern of interest rate movements and currency movements and what's a flight to quality asset and what isn't seems to have changed, because interest rates have bottomed at the long end of the yield curve. And I've been saying this for 5 years now, that the secular decline in interest rates at the long-term maturities is over. And in fact, in the next recession, long-term interest rates are likely to go higher, not lower. And what's happened since the Fed started cutting corroborates this somewhat radical idea of mine. When it comes to credit, spreads are tight, although you correctly noted that they're not on the tights of the year anymore. They're starting to widen. I think junk bond spreads are up by about 30 or 40 basis points. And yes, spreads have remained tight for a long time. But one thing that you also referenced a little bit is the quality of the public corporate credit market is better than it's been historically. It's way better than it was prior to the global financial crisis.
Okay, so yeah, he talks about the overall private credit, after this, but one of the important points that he makes over here is that the overall long-term rates, 30 odd plus, year rates are actually not going to go down. Okay, based on his expectation, I think they are going to go up, and he's seeing, again, the credit spreads are tight, long-term rates are going to go up. So these are kind of indications that it leads him to believe that right now the overall financial assets are definitely overvalued. So that's the other side of the picture. When you have someone who basically looks at, again, the currencies, the interest rates, the credit market so closely, I think you can get a different kind of view in terms of how he's looking at it. Plus, again, he said that the flight to safety in terms of dollar being the reserve currency, and everyone is actually trying to buy dollar, but that didn't happen. You saw that in the indicator that I showed you before, that the support level has been hitting hard for multiple times, but we have actually gone down towards the support level, and it has become a resistance. So we don't know what's going to happen next. Probably the dollar is going to go up or down. We don't know. But again, the indication that the probability that it might go towards the downside is highly likely. Okay, I think it's probably more than 50%. I would say, yeah, probably more than 50%. So let's see what happens. But I think those are some of the things that I want to talk about in this session. The other thing that I wanted to actually show you guys, one of the other very important picture, that this is probably being looked at by a lot of market watchers. Okay, especially I think a lot of people talk about this. In terms of the PE ratio, because these indicators can provide you a good indication in terms of whether you can figure out if the overall market is overvalued or undervalued. Okay, so historically, if you look at it from a bubble standpoint, we have 2001 bubble where December of 2001, the PE ratio of S&P 500 was close to around 46. Okay, so it was very high. Okay. And then if you look at the overall PE ratio in 2008, it was close to 119. So right now we are at 29. Okay, so in that case, it's kind of a counterintuitive argument to be made based on what Gundlach is saying in terms of the overall expectations for market to be overvalued. In this particular case, like if you look at the PE ratio, of S&P 500, it is around 30 odd number, right? But the indication that this could be a good indicator is a little bit more challenging, because of the fact that if you look at the overall significance of the Max 7 in the S&P 500, this is mind-boggling. The chart that one of the YouTuber, he's the guy basically who provided this chart. So this chart basically shows you the overall difference in terms of the Max 7 versus the rest of the companies, right? The Max 7 itself, it contributes to close to around 1700% of the overall profitability, um, in terms of the long-term impact that you see from 2012. Okay, but the rest of the S&P 500 companies are way down below. Okay, so the overall growth that you see in S&P 500 at this moment is only coming from Max 7, and they are the huge contributors. Okay, so that is a little bit of a difficult thing to digest, right? I mean, even though your overall S&P PE ratio looks around 30, but the contribution of the Max 7 in S&P 500 is tremendous. Like, it's huge. And this is another thing that I think uh, this Pension Craft YouTube channel guys talks about the fact that the overall profitability margin in terms of the Max 7 versus the rest of the company, it looks pretty good. That means the overall revenue that they drive, they have a very good efficiency of driving profit, majority of the revenue to profit, because they have a very low cost. What historically they haven't seen it before. So I think this chart talks about the overall forward profit margin from the Max 7 being much more efficient compared to the rest of the companies. But again, the fact remains is that if you look at the indicator in terms of the PE ratio, it is around 30. It's not as high, but then the contribution of Max 7 in S&P 500 is a huge, huge, it is a huge uh, indication of like the difference that we haven't seen in the past, right? I mean, the Max 7 has contributed much more market cap and overall performance uh, improvement in S&P 500 compared to the rest of the um, 493 companies. So those are I think some of the things that I wanted to kind of show you guys in this video. Hopefully you like it. Okay, if you like it, again, feel free to comment on it. Again, these are my views. These are some of the views that I'm getting it from other people. From obviously these guys are definitely veterans in the capital markets, and they know much better than I do. Okay, but I'm just throwing out my view on what I see, how I see the market, and how I am approaching the market right now. But if you guys like it, if you have any comments that you want to you want to talk about, I think you can definitely put that in the comment box. But bye for now. Okay, talk to you guys in the next video.